Hi everyone, Scott Schweiger back with another Tuesday tax tip. Last week we talked about the American Rescue Plan. You know, that massive stimulus package straight out of Washington. And while it wasn't officially law last week, it is now. So I'm glad my video holds up. This week, we're going to stick with the American Rescue Plan. Everyone knows about the stimulus checks that were part of the deal. In fact, some people were getting direct deposit notifications as early as last Friday, March 12th, literally the day after the president signed it. But I'm not overly concerned with stimulus checks. There's plenty of people out there who are going to talk about them to death. So, I want to revisit the premium tax credit and the unemployment provisions. First off, for you people who've already filed your taxes, just wait, be patient. The IRS has things to figure out. Don't go rushing out and filing an amended return right now. Now, I want to briefly go through the premium tax credit. There's an expanded subsidy and coverage for 2021, and that's great. But for 2020, the big change is that there's no premium tax credit reconciliation. So how this works is if you have marketplace insurance, it's subsidized with an advance of the premium tax credit based on what you estimate your income to be at the beginning of the year or when you enroll. If you make more than you thought, you have to pay back the excess premium tax credit that they have given you throughout the year, which can end up being quite substantial. The American Rescue Plan helps. It waives this reconciliation and it stops that clawback of the excess advanced credit. So, pretty good deal there. Now, let's tackle the unemployment. $10,200 of unemployment benefits are not subject to federal income tax per taxpayer. This means if you're single, up to $10,200. If you're married and you both got unemployment benefits, you can exclude up to $20,400. All right, the magic number here is $150,000. And this is a cliff threshold. So if you hit an adjusted gross income, or AGI, of $150,000, your unemployment becomes fully taxable. There's no phase out range. Okay, so that income limit, it's the same for single filers as it is for a married couple. So this is an example of what's called a marriage penalty, because two single filers who have unemployment, they each have a $150,000 threshold, which means up to $300,000. That married couple is still stuck at the $150,000, so it can lead to some problems, issues, and unfairness, but that's the way they wrote the law. Now, it would be in your best interest to keep your AGI underneath this threshold if you got unemployment. But what can you do? I mean, 2020 is over, right? Well, everything depends on your circumstance, but retirement is your low-hanging fruit here. Typically, you have until April 15th, or the original due date of your return, to contribute to pre-tax retirement plans for the prior year. So we're not talking about Roths. No Roth IRAs, no Roth 401ks, nothing Roth related. So there's still time, if you're eligible, to make these contributions up to the maximum limit, which will lower your AGI and help you stay under that cliff threshold. Likewise, HSAs typically have the same provisions. So if you haven't fully contributed to your HSA, that is another avenue to take. If you took out a COVID-related retirement distribution, we talked about those a couple of videos ago. you can turn this into a non-taxable rollover event. Now, not everyone's going to be in a position to do that. So the other option there is to utilize the 3-year stretch the 3-year stretch provision. And this basically will take your distribution, divide it into 3, and you're going to recognize it in each of the next 3 years. Again, this will lower your taxable income. And again, that depends on if you took out of a traditional 401k or a Roth-based retirement account. Nuances again, right? Finally, if you had college costs, college tuition, you can take a look at taking the tuition and fees deduction rather than the lifetime learning credit or the American Opportunity Tax Credit. This one's a lot more nuanced. Typically, a credit's going to be more bang for your buck than taking a deduction, but if you're really close to that threshold, it may make sense. This is one you definitely have to do the math on and go through the full calculations to see whether or not it works out. It's not one of those blanket, hey, you can do this if you qualify things. So take that for what it's worth. Now, this is not an exhaustive list of everything that you can do currently right now to lower your AGI for 2020. These are just some low-hanging fruit things that are off the top of my head. And I think I've seen some of them out. Other CPAs are doing a good job of getting some of these out on social media. Obviously, how this tip is going to affect you is going to depend on your facts and circumstances, like if you're eligible for retirement contributions, if you got unemployment benefits, if you filed your taxes, and what your income level ultimately is, just to name a few. So if you have specific questions, please reach out to your tax advisor or feel free to contact me. Thanks so much for watching, and I hope you join me next week for more Tuesday Tax Tips.